Well, people, the headlines say that we've been down 3 straight days in a row, but as you can see, price is really just going sideways, awaiting some big data. But there is something very interesting taking place in the markets, and I wanted to share that with you because we could be in for a sudden shift, a bigger move in the very near future. All that and more on today's Stock Market Brief episode, where we navigate the financial markets through the lens of technical and intermarket analysis. If you haven't done so already, make sure to hit that thumbs up. It is greatly appreciated. Let's get into today's show. All right, people, before we hop into the charts, let's take a look how the index products did and the 11 sectors that make up the S&P 500. You can see the VIX was the one that was up on the day, right? Volatility was up, and overall pretty much a flat trading day. There was a lot of volatility intraday, and we'll go over that. But overall, pretty calm day if you just take a look at the end of the day and you're not involved intraday. As far as the 11 sectors that make up the S&P 500, over here on the right-hand side, we have utilities that led the way, and they are a rate-sensitive name, and we had a big move in rates, which we'll discuss. Energy was down there at the bottom, and guess what? It's also a very rate-sensitive sector, and where we had the 10-year yield drop off quite hard. If we take a look at the heat map of the S&P 500, go figure, right? We have a down day, and you have the big red squares over here. The large mega cap names were down on the day. Tesla was the one that kind of squeaked out, rather unchanged, but a little gain, and you had energy bright red there. Typically, S&P 500 probably would have finished up on the day if it wasn't for energy's underperformance, because everything else across the board there did decent for the most part. Now, I brought up this chart to show you really how similar these two sides are. Now, I'm not just going to call out the obvious, the bearish engulfing candle over here, the bearish engulfing candle over here, albeit when this bearish engulfing candle took place, it did so on a lot larger volume than this candle right here did. I wanted to zoom in because we're at a very interesting point from a macro data drop standpoint and from a 5-day moving average perspective. So if I zoom in, we're going to zoom into this side first. This is what it looked like on the 15-minute time frame with the purple line, the 5-day moving average. And as you can see, we had this nice run up. And this is around the time, you'd have to go back and watch what I was saying back then, but this is where I say you want to be obviously more cautionary as price starts to flatten out here, and it could potentially go into a decline phase. I said right over here, right? You go back, I'm almost certain I said it. This is where you want to be bearish, but with caution, because we're still under a 5-day inclining moving average. Well, we gapped up, we tested it, we squeezed, and then we broke. Now, what's this over here? Well, that's the ADP numbers before we saw the big drop and the follow through to the downside. So why am I showing you this? Well, let me show you exactly the same chart, but zoomed in to over here. Bam. So I'm going to zoom in. I'm going to go back and forth really quick so you can see it. This was over here, right? That was the prior one. This is now. Prior one, now. Prior one, now. We're seeing some very similar behavior. And guess what? We just had our ADP numbers. Yes, we started up higher, which was actually a level we were keen in on. It was the upper daily expected move. We finished down there and actually near the lower daily expected move. I'll show you that later. But we are currently below, right, an inclining 5-day moving average. So you got to be bearish, but with caution, because we can potentially get right back up into that area, knowing darn well on Friday that macro data drop is going to matter. Now, we had ADP come in. Private businesses in the U.S. hired 103 workers in November 2023, but that was below a downwardly revised 106K in October, and it was below expectations of 130. So it was not a good report. We started the day up higher, and this is why we go over these daily expected moves. When they matter big. And you could see if you FOMO'd into this, right where this, gap fill areas, right where this was, we had price contract cooling up. We said potential explosive move. So watch for it. Well, we started there and we basically sunk throughout the rest of the day. Where did we tag lower? The lower daily expected move. And I'll go over the updated ones here soon. Now, going into tomorrow, we have some initial jobless claims number. We have some auctions. So that, be aware that can cause some more volatility. But Friday is the big one where we get non-farm payrolls and unemployment rate. So I just found it to be interesting that this consolidation, this break, and, this big kind of day right over here, just volatile day, both took place on the ADP numbers, and the structure looks very, very similar. And this is the reason why I'm telling you is not to predict that this same thing's going to happen, by the way, because I know people are going to think that. No, I'm showing you this because if you are aware when we get below that 5-day moving average and starts curling over, you could have saved yourself a lot, 3 months to the downside before we actually started flattening out and getting back up. So it's a way to protect yourself. That's what I'm showing you. It's about probabilities, it's about protecting capital, and so forth. Okay, now there's a couple big assets that moved. Take a look here at 10-year yield. So this was the head and shoulders we had plotted out. We talked about the potential for a rising wedge, which could very well still be there. But we had the head and shoulders measured move to bring us to 41 on the TNX and 40, this kind of range here. Well, we are in that range. So the measured move is now being approached or technically tagged, okay? So this is important because sometimes we can get bounces from these kind of levels. So if I actually just draw out a line, looking back to the left side of the screen, I'll keep on drawing it, you can see we had, when we cracked through here, we had this big distribution, boom, to the downside. We acted as resistance, then we started acting as support, we acted as support again, and price is coming right back into this area again. And if this bounces, well, we'll take a look here of what assets performed the best when it fell, and then we'll talk about what can potentially perform good if it rises. Also, to look at the dollar came into that golden range in the fib zone between the 50 and the 61.8%, and we're starting to see a bounce from there. But you can see during that time, take a look. The S&P 500 hasn't even moved, and typically there's a pretty strong negative correlation, meaning that the S&P 500 rallies like it did over here, right? See this V bottom start right here? Well, that was also, take a look. We're talking about the S&P 500 having very similar type moves. Well, guess what? During that consolidation, the dollar started rising. During this consolidation, the dollar's starting to rise there too as well. Does that mean it's going to go to all-time highs over here? No, it's just something, once again, to be aware of, and we will get more tactical. So in the short term, the dollar is rising, okay? And in the intermediate term, a couple months here, the 10-year yield has been falling. So what does this do from a relative rotation perspective? Let's take a look at the last 8 weeks, because the 10-year yield has been falling for the past 8 weeks. And really, the dollar has been falling for about that time too, since about October. So while the dollar was falling within this time frame, energy became one of the weakening sectors, a very strong move to the downside, okay? But what started performing quite well? Well, XLK. Well, okay, that makes sense. 10-year yield was coming down, dollar was coming off. It was a catalyst to see XLK start to move higher, and that's what we saw. You could see XLU, XLP, XLRE, rate-sensitive names. They were improving, but they were still kind of just right over here on the left-hand side, and it's a lot more bullish when we get more to the right-hand side, and we start to see the tail moving into the top right of the leading quadrant. Now, if I zoom into a smaller time frame, say the 5 trading days, because in the last couple of trading days, right, we've moved into this area of potential support, and the dollar's starting to bounce here. What do we see going on? Well, you see XLK starting to weaken. You see consumer discretionary starting to weaken. You see sectors like XLV, XLP, XLU starting to strengthen at this given moment. Now, the reason why I'm bringing this up is because it's clear to me that while the yields were falling, while the dollar was falling, what was doing the best? It was technology. What was doing one of the worst was XLE, because you can see not only from an absolute perspective, but this large, thick tail driving right down into that weakening quadrant. Now, I want to show you oil. Oil got completely cracked today, 4% to the downside. Now, I'm also calling this out as a full measured move for a head and shoulders pattern. We had a left shoulder, head, right shoulder. We talked about this bear pennant. We cracked that. And this right here, if you measure from the top of the head to the neckline crack to down here, the same distance, that brings us right to where oil came to, which is the first time closing, for 1, 2, 3, 4, 5 months or so under the 70 handle. So are we potentially going to get a bounce? So just be careful here, because oil might be signaling something big to come. And like I said, we have jobs report data coming out, but this could very well be an opportunity if you do trade oil, or if you trade energy names, because there's a strong correlation where we may potentially see a subtle bounce. You just got to be very tactical, very careful, and monitor positions, because this right here could be catching a falling knife. So they say. Now, if we take a look at the SPY, I'm going to show you the 30-minute time frame, and I cleaned up all the moving averages, all the anchor VWAPs on this specific one because I just wanted to highlight this channel. This channel is very similar to which really took place back here too as well. We had this kind of rising channel here too. If I take a look at the 30-minute time frame, you can see we broke down from that today, but we still haven't even tagged the lower weekly expected move. So going into tomorrow's trading session, 452.54 is the lower daily expected move. 456.98 is the upper daily expected move. Excuse me, my mouse is acting a little funky here. All right, there we go. Go ahead and continue. We're going to look at the SPY on the 30-minute time frame. Now, the reason why I'm using the 30-minute time frame right now is because the 15 looked a little too crunched up, so I wanted to just show a little bit more more stuff. So now I'm going to apply the 5-day moving average. You can see where we cracked down from it, and then I applied an anchored VWAP to this big massive gap up. So you can see price is actually still above it. So, and it's right in confluence with a lower weekly expected move. So this right here is an area of confluence to be aware of where we can potentially bounce. And if we do bounce, take a look here. So if we come down here, we tag it, we move around, wait for price to move, see if it starts bouncing back up, look for a potential retest of this breakdown, right? Typically when things are support, you can get a back test and test it as potential resistance for an entry if you do like to trade short. And the 5-day moving average, obviously we start, getting back below it like so, and then we might have further downside to fill this gap. That would be the more bearish case scenario. But as it stands, I'll give you the updated SPX. The 5-day moving average, yes, it's flattening out, but it is inclining as we speak. And then the gamma flip level moved to 45.40 as it stands right now. So, okay, we got a bearish with caution right here under the 5-day moving average, above a gamma flip level. So that's, bullish as it stands because dealers, they sell into strength, they buy into weakness. They sell into strength, buy into weakness. Volatility is typically reduced, creating this slow moves to the upside. It's not really what we've been seeing, but that's typically what it means from a gamma exposure standpoint. Now, if we start getting below this gamma flip level, really, this is where the fight happens. We would have to really kind of break down from that level substantially to get into negative gamma territory. And that's where volatility really increases. Okay, that's where we can have selling into selling, right? Boom, 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 and then buying into buying. So you see, strong moves in both directions. So SPX, if you guys want to download this chart, by the way, to get these levels, I'm not going to rattle them off actually. Download the chart with the link below. It's free. It's a PDF, high quality format. And that's all I got for you on today's episode, everybody. Hope it helps out and gives you some insight into what it is that I'm seeing in the markets. Bye.